The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The future of the stock rally gets hazier as the economic picture becomes clearer. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Here's where we stand with just about an hour to go. Slight gains when it comes to the S&P 500. You can see both the S&P 500 and the NASDAQ 100 higher by about 0.2% right now, which is more interesting than this small move would suggest because you do have Apple shares lower on the day of their big event. We'll get to that in just a moment. I wanted to highlight the small caps. BLS revisions clearly front and center today, coming in much bigger than expected, those downward revisions. So that's really hitting the small caps because this is, again, more proof that not only is the labor market weakening, but it's weaker than maybe we expected. For some reason, the response has been to sell bonds. You can see the 10-year, actually the 2-year up here, 2-year Treasury yields higher by about 5 basis points right now. Of course, we know that we've been rallying hard when it comes to the bond market, but still an interesting reaction function here.
A lot to cover here today on The Close. Katie Greifeld, as we do every day, connecting all aspects of all assets, including in commodities, where we're seeing gold lifted to another record high on the back of Fed rate cut bets, while lithium prices and Albemarle pushed ever so lower as China restarts this key production source of the metal, and some big swings in oil prices, too. This after Israel conducting an unprecedented, unilateral, unprovoked missile strike against the Qatari capital of Doha, a strike Netanyahu said was intended to target Hamas. As geopolitics bubble back to the surface, so too are concerns about the health of the U.S. labor market. The government's annual review of past jobs data benchmarks, that's showing the pace of hiring in the 12 months through March. That was about half that of the previously reported numbers. Evidence that the job market has actually been weaker for longer than policymakers had previously been able to discern.
We're having a more pronounced cooling of labor supply and demand than we had expected.
We're going to talk about that story. And of course, we have to talk about the other big story of the day, Apple's annual product launch event, an infomercial to be sure, but an infomercial of which the market hangs on every word. Some big questions about how the fourth most profitable company with the third highest public market valuation actually broadens growth for a core iPhone business that transformed the market for mobile tech devices after its launch about 18 years ago.
So plenty to get to coming up on The Close, but let's go back to oil. As Romaine said, we've got our eye on all the asset classes here. So we put up this oil chart. You're taking a look at Brent in blue versus the OPEC crude output. So we know that OPEC boosted its production over the weekend by less than expected, but still a boost nonetheless. Then you layer on the news that we got this morning, that geopolitical news about that strike. Interesting to see how oil has reacted. For better or worse, it seems like these two lines are really the relationship here. And the question for oil so long, Romaine, has been, when do you build in that risk premium? It never seems to hold for long. It seems to be the supply picture that really drives prices more than anything else.
Well, our first guest kicking us off The Close says that for a lot of oil traders out there, it's been like chasing shadows. So many events pushing oil prices in various directions. And of course, today, the latest was that attack in Doha. Rebecca Babin joining us right now, senior energy trader over at CIBC Private Wealth. And Rebecca, talk about those shadows, because I don't know what to pay attention to in the oil market. What's going on with Israel and Hamas, what's going on with the Red Sea attacks, what's going on with Ukraine and Russia. Where do you look right now?
So I think you're hitting the nail on the head, and it is like chasing shadows out there. One minute you feel like you kind of have a good sense of, is there supply at risk? Have things started to de-escalate? Are they escalating? And the next thing you know, the headline shifts and you have to kind of go back to square one. Right now, I think the key for the market is not the geopolitical risk premium. I think the market and traders, to a certain extent, have given up a little bit trying to effectively price that, just with the amount of noise and headline risk in the market. The supply risk is going to get priced in the market when the barrels leave the market, when there is an impact. Leading up to that, we may see these mini spikes, but there's just a degree of hesitancy to actually price that in until they're off the market. And the reason for that clearly is that we've been at this for several years, 2-3 years of increased tensions in the Middle East, and no supply has actually been impacted.
Well, that's what I'm Well, that's what I'm curious about, because we had the knee-jerk reaction in oil markets when we first learned about the attack around 9 a.m. East Coast time. But the big question here is, why would that, at least in the immediate term, actually impact the flow of oil out of the region, particularly given that we know that the biggest impediment to that in the past was Iran, and its proxies. Iran and its proxies, of course, that have been severely hobbled since the retaliation by Israel over the last couple of years.
You're right. So there not only is there less ability for potential retaliation, but there seems to be less willingness from some of those players to target energy as directly as we've seen in the past. So the Houthis very well may, they've supported Hamas in the past, re-escalate some attacks in the Red Sea. But guess what? Most oil supplies are rerouted already from the Red Sea and not using that route as much. So that limits the kind of impact on the market. So we're looking at the push-pull of, can they do it? Do they want to do it? And has that flow already been redirected anyway? And the market's coming to the conclusion that, there's very limited kind of ability for them to kind of meaningfully impact the supply for a long period of time. Now, the real issue here, though, and the reason why we don't see these rallies hold, is that there is excess supply in the market, and you talked about it in the lead up. OPEC Plus has come out and really unwound a tremendous amount of their production cuts, over 2 million barrels a day. Not all of that is actually resulting in barrels on the market, and a tremendous amount has been put in China strategic petroleum reserves. However, there is no shortage of crude available to hit the market, and the market seems to really focus in on that as the buffer that keeps kind of any kind of fear about geopolitical risk in check. So it's not having realized any supply loss in the past and having that buffer that I think keeps traders really reluctant to chase these rallies.
So, Rebecca, when you weigh these two different factors together, you have all the supply considerations, and then you have the geopolitical tail risks, if you want to call them that. You take a look at the price of Brent. It's trading at $66.50 right now, give or take. The average for the past year or so has been right around those levels. And for the past 3 months especially, we've been mostly trading in this range of $65 to $70 a barrel. Do you think that that's reasonable?
I do. And I tell you, many people think that we should be much lower. The question I get asked the most isn't why aren't we rallying on geopolitical risk? It's why aren't we in the 50s? And that's because everyone's looking at this impending surplus coming in the fourth quarter of the market. And I'll tell you, that is such a consensus view, and the bearish undertones to the market, if you look at positioning, the amount of hedging that's happening, that is very much priced in. So the calls for 50 crude, I think at this point, you'd have to see some pretty negative numbers to get us there, just because it's so wildly consensus. And again, the upside is buffered by the fact that we do have non-OPEC supply growing and demand kind of okay, but not great. So we're kind of trapped in this range. And I do think 65 Brent, 60 to 70 Brent is very reasonable. And I think we will stay there. I don't think we're going to have that massive drawdown to the 50s or a spike north of 80. I think the factors all combined into this messy shadow chasing trading environment kind of keeps you stuck 60 to 70 for Brent. It's not as exciting, but I think that's where we end up.
All right, chasing shadows. Rebecca, really appreciate your insight. That is Rebecca Babin. She is senior energy trader over at CIBC Private Wealth. Meanwhile, turning to the economic front, with the latest payrolls revision setting the scene for PPI and CPI later this week, there's a lot of data for Wall Street to parse through. Plus, there's also plenty going on in the tech space between Apple's latest iPhone event and Oracle earnings out after the bell today. So let's wrap it all together with John Belton. He is portfolio manager, managing director for growth portfolios over at Gabelli Funds. John, great to have you with us. Let's start, of course, with the economic picture, because those numbers hit this morning and showing that there has been a record downward revision to that payrolls numbers for the year through March. And that has, for a lot of people, meant that, okay, we know that the labor market is weakening, but we're coming off perhaps a much weaker base than we were expecting here, John. What does that mean for you and the portfolios that you manage?
Well, yeah, thanks for having me, first of all. I think, this is the second consecutive big revision in this set. The thing about this, though, it's pretty backward looking. So this is a revision to payrolls through March. And you can't, the way this revision is done, you can't just map that to the current environment and say, okay, if this revision implies that monthly payrolls were about 75,000 per month less than we had been thinking, it's still 75,000 per month less than we've been thinking in the current environment. But I do think you can step back and say, all right, the last several months, payrolls data has been clearly softening, if not outright soft. And the magnitude of these revisions probably says, on balance, it's even softer than the recent data has been saying as well. So clearly, labor market softening should probably be on net a little bit dovish for the Fed ahead of the meeting next week. We'll see how that plays out.
Yeah, certainly we do have PPI and CPI to get through. But to the point that you're making, that maybe this puts a little bit more pressure on the Fed to be dovish, even though, of course, this is relatively stale data. As I mentioned, you're the managing director for growth portfolios. You think about growth equities. How much do they need a rate cutting cycle here? Not just a 25 basis point one-off cut, but a rate cutting cycle at this juncture.
Well, I think it's hard to generalize about that. I think it's a little bit case by case, depends on the company, the sector. But obviously, lower rates, if you assume lower yield curve, upward pressure on equity valuations, that's a positive starting point. I think if you're in a lower growth environment, maybe favors some of the secular growth, kind of the large tech type names that have been working, maybe favors those types of stocks in a low growth, lower rate environment. But we're paying very close attention to this labor market data, and it does seem like we are very much the environment is very much slowing, and we're going to have to pay attention to that unemployment rate. I think one thing that's really interesting about this revision is, if payrolls were so weak, why have we really not seen the unemployment rate budge much? It's kind of been stuck in that 4.1 to 4.3% range, still pretty benign, historically low. So we're really watching that unemployment rate pretty closely moving forward.
Yeah, and we should point out, John, too, just for our viewers, we're going to have a conversation just up ahead with the former BLS Commissioner Erica Groshen, also former Vice President over at the Federal Reserve Bank of New York. And I think we will be posing that question to her directly. But, John, I do want to pivot a little bit and really get to your expertise in the tech sector, because this is a big day for tech. We're expecting Oracle earnings after the bell tonight. You've been a big investor in NVIDIA and a lot of other companies in the AI infrastructure build out. The expectations are high, but so far, Oracle seems to be in a pretty, sweet spot, if you will, when it comes to its position in that space. What are you expecting tonight, and do you think they'll deliver?
Yeah, I think Oracle, the expectations are pretty high heading into tonight. If you rewind back 3 months ago, last earnings cycle, it's really a blowout quarter. Everything you want to see as an Oracle shareholder, which we are, we saw really strong database results, strong cloud software results, and then enormous growth in Oracle Cloud Infrastructure, the public cloud business. They established full year ahead guidance 3 months ago. That was way ahead of the street. So clearly the business is clicking. And we want to see a continuation of that tonight. 3 months ago, Larry Ellison talked about demand for Oracle Cloud Infrastructure as being insatiable. He said it was unlike anything he's ever seen in his career. His career is a lot longer than my career has been. So I think that is a really relevant data point. So want to hear, more positive commentary about the demand backdrop for AI infrastructure.
When we talk about the AI build out overall, there's been obviously a lot of focus on the software side, a lot of focus, of course, on data centers and AI infrastructure. There's now been a little bit of a pivot, at least in investors' minds, to the hardware. Earlier today, we did hear from Apple, its next iteration of its iPhone, the next iteration of AirPods, and hopefully more to come down the road here, John. When you look at what Apple rolled out today, and more importantly, what they've articulated as to their strategy to build out that iPhone ecosystem, and at some point, to try to harness all the hype and promise around AI, how much confidence do you have in that strategy?
No, I think first of all, I'd say I thought Apple's event today was actually quite positive. I thought it was quite impressive. The highlights for me, first of all, this AirPods Pro 3 product that they rolled out, they introduced this live translation feature. I thought that was a really interesting use case for AI on device, which is, I think, broadly what Apple's AI strategy is right now, to be the AI on device leader. And so, the concept of having headphones in that allow you to converse in real time with somebody who's speaking a different language, that's pretty cool. I thought the iPhone features, most of that had sort of been leaked a little bit in the press. The iPhone Air being the big, new form factor for iPhone, that probably sets the stage for them to roll out a foldable iPhone down the road. But I think the stock's a little bit off, maybe on the pricing for iPhone 17 not being as big of an increase as hoped for. But I think stepping back, what's Apple's strategy for AI, to your question? Right now, I think they're kind of slow playing things. This market is moving very fast. I think they're slow playing things. They're happy to, with their massive installed base of users, to be a distributor of AI, much in the same way they've been, as a distributor of internet technology over the last cycle. So I think their strategy, we'll learn more about it as time goes on. But for now, it's to be the leader of AI on device.
All right, John Belton over at the Gabelli Funds. And we should point out Apple shares did briefly get into the green during that event, but eventually lost steam. Right now, down about 1.5% on the day. Our very own Ed Ludlow, the co-host of B-Tech, he's outside Apple Park in Cupertino, California. And Ed, I do just kind of want to point out, you kind of sit in a very interesting spot. We talk about sort of that milestone event back in 2007, where maybe just about 50 miles or so north of you, Steve Jobs walked across that stage and introduced what at the time was something revolutionary. It really did change what we thought about mobile computing. Now, 18 years later, there's a lot of questions as to how you move the needle forward for a device that sells 200 million units a year, generating $200 billion in revenue a year just on the device alone. What did we learn today here about the potential to grow that even further?
You highlight that the iPhone event day is almost always a sell the news event, but the stock often recovers on a 30-day, 60-day or longer term period where the handset is well received. The iPhone 17 lineup, from the base model through to the Pro Max and the Air in the middle, is as Bloomberg reported it would be. Heavy emphasis on the Air, 5.5 millimeter thickness in a market where Samsung has already bought an ultra-thin phone. But the focus very much on pricing. Why? Because of the tariffs environment and the pressure on Tim Cook and Apple to move more of the supply chain to America, but we are in a higher cost environment. Note that on the Pro model, the cost is about $100 higher than relative to last year's generation. However, the storage available in that handset is double. And so something your guest was talking about in the last segment, the innovation across the lineup is in the silicon, proprietary processors across GPU and CPU, and a heavy emphasis from Apple that the capabilities of that processing, as well as the energy efficiency and the heat management, that is the hardware story behind the AI story that Apple did not tell. Also interesting to see the tick by tick. When the AirPod Pro 3 did get announced with simultaneous translation, the stock made a market move from down 0.7% into positive territory. But look at the landscape. Meta is already doing simultaneous translation through its virtual reality and smart glasses with Ray-Ban. It's not something that new, and other OEMs like Google have done simultaneous translation in the products that they've released this year. But for Apple, this is the story. Is it enough on the capabilities to drive an upgrade cycle? The pricing is important. It is not a real terms raise in prices, but what will incentivize the consumer to go out and drive it? And you're exactly right. 50% of this $3.5 trillion company's sales are the iPhone, and the timing of this is substantive. We're in the fiscal fourth quarter. The iPhone of this 17 generation will go on sale within that quarter, but next quarter, fiscal first, that's the holiday period. That's what it comes down to with Apple. All the extra stuff, the focus is a spring release, as we've reported, on Siri and Apple Intelligence. That will bring us back to the software story on handsets, which, according to Apple's presentation today, will be more than capable of handling developments in AI.
All right, Ed Ludlow, the co-host of B-Tech, he's going to be sticking around outside Apple Park there in Cupertino, California. Katie?
Yeah, a lot of focus, of course, on Apple, on the hardware, but on the broader universe. And to that point, coming up, a conversation with T-Mobile's Chief Operating Officer live from Apple's event in Cupertino. We'll bring you that conversation next. This is The Close on Bloomberg.
Apple earlier today introducing the new iPhone 17 lineup at their annual product launch event today. Pre-orders expected to start taking place maybe as soon as this week. A new model that could be a growth catalyst for U.S. carriers like T-Mobile by boosting device sales and upgrades. Ed Ludlow is outside of Apple Park in Cupertino, California, and he's standing by right now with T-Mobile's Chief Operating Officer. Ed.
Yeah, T-Mobile CEO Srini Gopalan, and we know the pricing, we know the lineup of the 17 generation. Now it passes to the carriers. What's the trade-in deal going to be?
So look, the reality is we have the best iPhone, and at T-Mobile, you have the best network with the best value, right? So there's only one place you can get all three: best network, best iPhone, best value, and that's at T-Mobile. Customers who come into T-Mobile starting now get the best deal. They get the iPhone 17 on us, and they save at least 20% in comparison with other carriers.
Okay, let's be specific here,
Yes.
because if you went to the T-Mobile website this morning,
Yeah.
you would have got the iPhone 16
Yeah.
on us.
Yeah.
On us meaning no trade-in required.
Yeah.
You will eat the cost of the handset
Yeah.
while tying the customer to a long-duration contract. Explain the economics and why that's a good deal.
So look, when we look at new customers come in, firstly, on the iPhone 17, it'll get stratified depending on which model you're coming in on, and there'll be different trade-in offers that apply. But more broadly, if we think about this, right, we believe that when people come in for a new phone, we also get really strong revenue because they get a really, really good experience, especially at T-Mobile, because in many ways, we have built our network. We've built our network for a product like this. Our superior 5G network, which we built years ahead of our competition, that's what you need to get the best out of your new iPhone. And you also get new value. For decades, we've lived with this contradiction, right? Over 70 million Americans chose Verizon or AT&T as the best network in the 4G era. And they probably made the right choice then, but they paid a premium for it. Today, for the first time, right, over the last 3 to 5 years, as our network has become the best 5G network in America, you don't need to make that trade-off any longer.
But, you know, the 5G upgrade cycle, with respect to it, it's kind of been and gone. So when you looked at, and I'm assuming you've been negotiating with Apple for months, right? But when you looked at the technological updates to the iPhone 17 generation, base through Pro Max, what were your expectations for an upgrade cycle purely on the capabilities of those handsets?
So when we look at the amount of innovation that's being unleashed today, we're very optimistic on what this will do to the upgrade cycle, as well as to the number of switchers that are there in the market. We love an environment where lots of people switch, because when you're switching and you have the choice of best network and best value, there's only one natural place to go, and that's T-Mobile.
What was your reaction to the pricing of these handsets?
I think the pricing is exactly what we expected. We're really bullish and optimistic about how we drive this forward and bringing in more customers onto the best network.
It's academic somewhat now, because Apple didn't really in real terms raise pricing. On the Pro, it's about $100 greater than the prior generation, but the storage is double. So take that what you will. Had prices gone up, would T-Mobile have had to pass them on to the consumer in this environment?
Look, we look at each of these things as they evolve, but I think we were very clear in a lot of our messages, including at our earnings call, that the economics of this business does mean that when you have a substantial price rise, you do need to pass that on.
Right. But the economics of this generation of iPhone, they make sense for T-Mobile, even with an on-us approach?
Absolutely, they make sense. The lifetime values we get from our customers now, especially with new handsets, with new capabilities, because of the quality of our network and the loyalty that that engenders, apart from the fact that we provide great value, that combination means our economics on this is something we're very, very happy with.
Srini, take me inside the negotiations with Apple. Do you basically early commit to the same inventory for this generation of phone as you did with the 16 far in advance? Or do you let it play out and see what happens? Help us understand how you manage that.
Our relationship with Apple is really strong. So this is a deep partnership where we spend a lot of time talking about this right from the point that the whole thought process on it has gone. So to characterize it purely as a negotiation, I think is wrong. There's a lot of co-development that happens, and part of it is volumes, but this is a much broader picture. One of the reasons why we're so excited by this iPhone is it works best on T-Mobile, because a lot of the features we've built into our 5G standalone network support this generation of iPhone. And that's not true.
So you're
in a lot of other
modeling for
places.
greater 17 generation sales than you saw with 16 initially?
The customer will decide where a lot of this plays out. But we like a world where it's simply not about sales with us. It's about the amount of switching that happens in the industry.
Right.
We like jump balls. We like a world where customers are switching.
Well, switching takes us to the iPhone 17 Air, ultra thin, 5.6 millimeters. Samsung, another OEM handset that you carry, has the Galaxy S25 Edge, 5.8 millimeters. As a segment, what have you seen in this calendar year for consumer appetite in the markets you operate in for an ultra-thin phone?
So we see that hardware innovation does excite consumers, right? And we're really excited about this hardware innovation. Hardware innovation as a whole does get customers more excited, and they do relook at their options of whether I want to stay with the old handset or move to the new one.
Across all four variants, which do you think will be the volume, but I also think probably margin driver for you?
Can I just tell you which one is my favorite?
Go ahead, but know that you're answering on behalf of your company, T-Mobile.
Yeah. Well, I love the cosmic orange color.
Okay.
And when we talk about, look, different customers will choose different options. We don't think of this as where do we single-handedly make the most margin. Our commitment is to provide the best network with the best value. When we do that, margins and financials are just the result of that. Because what we are about as a company is just breaking through these age-old trade-offs customers have had to make. So we don't think of this as, I make more margin on this handset, therefore let me sell more of this handset. We think of it as, what is the pain point the customer is trying to solve? We come from a place of, if we smash through that pain point, we will all be better off, the customer and obviously us.
Srini, one of the biggest news stories this week has been in the world of satellite-connected handsets. The story, Starlink and EchoStar. You have an existing relationship with Starlink. I was part of the beta. It worked. But what is T-Mobile's reaction to that been? And in the context of Apple, do you expect to focus more on satellite connectivity with the handset?
We're delighted with what Starlink's done. We started this partnership with Starlink with a mission, with a goal, to put an end to dead zones. And we're delighted that our partner, our strategic partner, has now made a big, significant investment, which will drive that mission forward.
You've just joined T-Mobile in March of this year, but you are a veteran of this industry, if you don't mind me saying. You understand how this works. Where does this iPhone 17 generation and today's launch rank in the history of iPhone events, in driving an upgrade cycle, in moving technology forward?
We all heard why it's the best iPhone to date. As far as the upgrade cycle and where this drives forward, the thing that we get very, very focused on is what does this do to stimulate more switching? Because the reality is a great new handset does start breaking through the inertia that millions of Americans are in, or a false trade-off that they've made in the past, where they've chosen a network and paid a premium for it, believing that network and value are somehow can never come together at the same point in time. We see this as a big opportunity, as a big moment to drive that switching further.
Srini Gopalan, T-Mobile's COO, with a very clear message. They think they can get customers to switch to T-Mobile, to the latest generation iPhone handset based on today's launch. Romain, back to you in New York.
All right, 12:30 p.m. out there in Cupertino, California, 3:30 p.m. back here in New York City as we count you down to the closing bells. Romain Bostick alongside Katie Greifeld with a focus on the broad markets with the S&P holding in the green. We should point out while Apple isn't the biggest decliner on the day on a percentage basis, it is the biggest drag. Of course, that is a hat tip to the fact that it is the third biggest weighting in the S&P 500, down about 1.5% here, but a lot moving here today on a very busy day for markets.
And perhaps a sign of resilience, a sign of health, the fact that you do have the market broadly higher right now, even though you do have Apple acting as a weight here. Also shaking off the BLS revisions that we got this morning, certainly larger than most had expected. And even though it is a bit stale, it does paint a picture of the labor market that has been weakening for some time now.
Yeah, I remember when we made a big to-do about this a year ago in the last, and I didn't quite understand why we were making such a big deal. But just to kind of put this in context, basically what they came out today, every year they benchmark at basically March, and they look at the previous 12 months from the end of March going back, and they say, what do we need to change? They've gone back and they say, when you average out those 12 months, there was roughly 76,000 fewer jobs created in each one of those months on average. That's about half the pace of what was originally reported. So that basically tells us that for all the people saying that maybe the Fed should have paid a little bit more attention to weakness in the labor market, they have evidence today that that weakness, at least more than a year ago, was there.
And also, it does provide some cover, some justification to what we saw from the Fed last September, that 50 basis point rate cut. It was controversial at the time. It's controversial even now. But the fact that we do have this revised picture of the labor market perhaps being less strong than we had thought at the time does certainly lend some credence to that. And
we should just point out, you talk about the controversy. Of course, the White House has made it a big deal, including today, the Vice President, James David Vance, out saying that, in his words, BLS data is useless and there is needed change to restore confidence in the numbers and, more importantly, in that agency.
Yeah, the politics of this moment certainly front and center here. Let's discuss with Erica Groshen. She is Senior Economics Advisor at Cornell ILR School and the former commissioner of the U.S. Bureau of Labor Statistics, a role she held from 2013 to 2017. Fantastic to have you with us, Erica. And let's put aside the politics of this moment, even though it is hard to do. Just looking at the figures, the numbers themselves, it's clear to see that the payrolls revisions have been getting larger over the past several years, culminating in today's release, a record downward revision. What are the different factors that led us to this moment?
Well, the BLS was a little able to tell us a little bit more about what the issues were that gave us these big revisions, right? Now, remember, this is the time of the year where BLS said, well, we've been conducting a survey for the past 12 months, and now we're going to compare it to very much detailed and more comprehensive administrative data and see how close we are. And usually they're pretty close, and in total, they're still pretty close, right? The difference is just 0.6%. But all of that difference is concentrated in this past, in those 12 months from March to March, 24-25. And what they said is, and this is the interesting part to me, what they said is that this was due to two factors, one of which, frankly, I was concerned about because the response rate to the survey has been falling. It's fallen by about 50% in 30 percentage points, but that's about 50% in the past 10 years.
Right.
So what that's done is introduced some bias. And that is that the companies that aren't responding, it turns out, weren't growing as fast as the ones who did respond.
I am curious, though, Erica, specifically about the response rate. And there has been, politics aside, very fair criticism that even predates the Trump administration about the data collection practices. Not so much that they were flawed, but that maybe they just didn't evolve enough with the times. The idea that no one's sitting by the phone at home on landline anymore. Survey responses on mobile phones aren't necessarily what they are. The submission of reports isn't necessarily as timely as what it used to be. When you were there back in 2013, 14, 15, 16, in that range there, what was the discussion like about trying to modernize the collection practices?
Well, it was very much underway while I was there. So actually, if you look at what happened to the response rate while I was there, and I'm not taking credit for this, but it certainly happened while I was there, the BLS was introducing more and more electronic means for the firms to respond. And so the employers really gobbled this up. In fact, BLS had a long waiting list to get the companies onto these electronic means of reporting. And so, and during that time, there was no decline in the establishment response rates. So it was able to stave off that decline by reducing the burden. And now the vast majority of employers who report this information choose to do it electronically and do that. So it's clear that that was an important factor in keeping the response rates as high as they've been. But frankly, there was a big decline during the pandemic, and BLS hasn't been able to get enough of those establishments back to reporting.
Well, I'm glad that you brought up the pandemic because, I mean, as you mentioned, you were able to stabilize that decline while you were there. But it feels like the pandemic really disrupted a lot of things when it comes to data collection and when it comes to how people, of course, respond to these prompts. But this seems like an existential question, Erica. If you can't necessarily not only stabilize but boost that response rate, I mean, what does that mean for the future of the quality of the labor market data that we have at hand?
Right. So that that's a really, really good point that you make. What's happening here is that the falling response rates are not specific to BLS, to this survey, to BLS, to the public sector. And not even to our country, right? There's a declining response rates to surveys all over the world, any kind of survey. The federal government, and BLS in particular, still has amongst the highest response rates in the world, but they're all going down. So to get to your point, what do we do? And that's when people talk about modernizing the statistical system, that's what it's all about. Because at the same time that you have the response rates going down, you have a burgeoning of electronic data of all sorts throughout the economy. All our transactions are all now being recorded.
Yeah.
And the statistical agencies can't wait to get their hands on that data and to design new kinds of measures to take that in.
Who is leading that? Who is leading that charge, though?
Project.
Who is leading that charge right now, though, Erica? I mean, in addition to your role as BLS commissioner, at one point you also did serve on one of the user advisory committees that have now been disbanded. And I am curious, we talk about this idea of having faith in the data that comes out of the government. It's not so much just faith in the data, but it's faith in the people who are in charge of either collecting that data or, in this case, overseeing the collection of that data. Do you have faith in those people right now?
Total. I really do. These are some of the most dedicated data nerds on the face of the earth, right? They are real. They live and breathe getting the data out there, making sure it's good, making sure that it's that everybody trusts it. That's what they wouldn't choose to work there otherwise because they could earn more money elsewhere. These are the people who really believe in it, but they've been hamstrung by a declining budget. Right? BLS's budget has fallen by 20% in real terms in the past 15 years, and this administration has proposed cutting it by another 8%. And right now, BLS is down. Since January, it's lost 20% of its staff.
Yeah.
1/3 of its leadership positions are vacant. So the ones that are there are perhaps the most dedicated people left.
All right.
And,
all right, Erica, we have to leave it there. We are up against the commercial. Really appreciate you taking time for us, and obviously a very complicated topic, and it's going to take quite a few weeks, if not months or even years, to sort it all out. Erica Groshen is the former commissioner of the U.S. Bureau of Labor Statistics and now over at Cornell ILR School. All right, when we come back, we're going to turn our attention back to what's going on in the stock market. And, well, one of the biggest decliners on the day and a real-life succession. We're going to talk about the Murdoch family and talk about the effect on the shares of Fox Corp when we come back after the break. This is The Close on Bloomberg. Welcome back. The long-running succession battle for Rupert Murdoch's media empire appears to be over. A settlement reached between Rupert Murdoch's estate and the family members, the potential heirs there. 21st Century Fox, Fox A shares down about 5.8% here on the day as Lachlan Murdoch, Rupert Murdoch's eldest son, now said to have gained control over the future of that company. Hannah Miller joins us right now to talk a little bit more about what we know here. This was a saga that's been playing out for years, and is this it? This is Lachlan Murdoch's company now?
Yeah, this is it. Lachlan Murdoch now will have sole control over the companies. He has the voting power that he will inherit from Rupert Murdoch after his death.
And talk to us a little bit about why shares are down specifically. This isn't necessarily a vote on Lachlan's management style.
Yeah, so there's actually a stock sale happening right now. Lachlan, 3 of his other siblings, they're getting $1.1 billion payouts for each of them. and that's stock is being sold to fund those payouts. And that flood into the supply of all the stock coming in, that's depressed the price.
And we should point out, I mean, to Katie's point here, I mean, Lachlan has effectively been running the ship for some time. So in the mind of investors right now, based on this settlement that we've learned about, is it pretty much just status quo, or are we expecting to see some major changes in the way this company operates?
Yeah, investors are very familiar with Lachlan's management style already. He's plotted a steady course for Fox. They had a new streaming service launch in August. They had the acquisition of Tubi. You know, he's made these bets with a focus on profits. You know, he's maybe not as colorful as Rupert, but he's put both of these companies in a stable direction.
It's hard to be as colorful as Rupert.
It's interesting. Okay, so a focus on profits here. I mean, talk to us a little bit more about the future. If it is status quo, I mean, you think about all the different tentacles that Fox has spread into. What's left?
Yeah, so the media landscape right now is rough.
I've heard.
And Fox and News Corp, they've actually fared very well. We've seen the Wall Street Journal really embrace the digital era. You know, they've done well even as digital advertising has declined. Fox News is the most watched cable news network. So yeah, he has a healthy empire at the moment, and I think he's just going to try to keep going and see what happens.
All right, Hannah, great reporting. Appreciate it. That is Bloomberg's Hannah Miller, of course, reporting on the real-life succession story. Now, we are just about 15 minutes away from those closing bells. We'll take you through all the action with Dana Dioria. She is co-CIO at Envestnet. Next, this is The Close on Bloomberg.
If you're in a lower growth environment, maybe favors some of the secular growth, kind of the large tech type names that have been working. We're paying very close attention to this labor market data, and it does seem like we are very much, the environment is very much slowing.
John Belton over at Gabelli kicking us off to the close just about 50 minutes ago, and the market's really having to digest quite a bit here today. Katie Greifeld, we talk about obviously what's going on with regards to the BLS data, signs softness in the U.S. economy, a lot of concerns about geopolitical issues, and still a lot of questions right now about the tech trade. But we should point out the S&P and Dow at record highs.
The Dow, have
I know you love the Dow.
A close eye on the Dow, but especially on the S&P 500. You're right, it's an incremental gain, but that's good enough for a record high. Even though you have Apple lower on the day, I think the small caps are such an interesting trade right now because that's where you're seeing these economic concerns, as we got another reminder of in the BLS revisions that we got this morning. But again, the reaction has been to sell bonds, a reaction I don't quite understand, but two-year Treasury yields higher by about 6 basis points.
Yeah, I'm curious about that as well. And obviously, we're going to find out a lot in about a week's time when the Fed meets next Tuesday and Wednesday, gives that, of course, that rate decision on Wednesday. And hopefully, we'll get a little bit more clarity out of Jay Powell about the path forward for rates. Although Katie makes a great point here about the laggards that we're seeing today in the Russell 2000, in the mid caps, in the transports, the economically sensitive sectors of this economy coming off a massive revision, downward revision to labor market data from the last 12 months. Dana Dioria joins us right now, the co-CIO at Envestnet. And Dana, I do want to start there. This idea of an economy, I don't want to necessarily say it's weakening, but it certainly is weaker than maybe what we thought it was based on the data that we initially had. And I am curious if that changes at all the calculus about how you invest in this market going forward.
Yeah, well, so certainly, if there's any good news to pull out of this, and I think the September rate cut was already a foregone conclusion. But to the extent that there was going to be some limitation on cuts for the rest of the year, I think we can say that the Fed at this point is going to be cutting. They'll be on a, it'll be 3 this year at least. There's, I came into the day sort of, of the mind that it's not going to be 50 basis points. I don't think that's out of the realm of possibility, right? And so, I do fear that investors will kind of look at this and view it as, okay, there's a looming crisis going on here. Is it time for me to kind of move money to money markets? I don't think that's the picture that, certainly retail investors that we cater to should be taking from this. I don't think it means move money out of the markets, but I definitely think it means we're clearly in a weaker state than we thought. Tariffs, government layoffs, these things, higher interest rates have all had more of a toll than we realized.
Well, what's the balance between the prospect of a softer economy and the prospect of significantly lower rates? The idea being that small caps, mid caps would actually benefit from an actual rate cutting cycle, a prolonged one. What's the balance, though, if we're also that's coming against the backdrop of an economy that's taking a downturn?
It's interesting because so certainly rate cuts help a lot, to your point, on areas like small caps and mid caps, right? Small cap companies are more likely to need to go to capital markets to raise funds. They're more likely to have floating rate debt. So they're much more interest rate sensitive. To your point, if we have a rate cutting cycle, that could absolutely boost the economy. It could boost all these small cap areas of the economy. And we kind of have a barbell, right? If you look at the US right now, where you've got, big tech, AI, large growth, killing it, and the S&P looks great. And then you have sort of this whole swath of, even within small caps, unprofitable companies. And so the opportunity to get access to capital more easily, I think, absolutely can spur, more economic growth. But to the extent that, tariffs, to the extent that we're a little bit too late on these rate cuts, we could see that sort of pulling against the impact that the rate cuts have now.
Yeah, absolutely. That bifurcation that you describe, it's been there for a while, developing for a while, but it feels especially dramatic right now when you think about the different size tiers in this market. I want to talk a little bit more about the bond market, though. I know that you can't make too much out of a single day's action, but I'm going to do that right here because, again, 2-year Treasury yields up 6 basis points today after we got BLS revisions that you would think on net might make the Fed a little bit more dovish. How do you explain what's going on in the bond market?
Yeah, it is absolutely interesting. And I would have expected, to your point, I would have actually expected that if anything, you'd see a little bit of a decrease. I actually take some comfort in this, that the market maybe to a certain extent has priced a lot of this in. So we're not seeing a huge reaction here. The fact that we're going to be in a rate cutting cycle is already sort of priced into the market. And we are, seeing hopeful signs here around just rates in general, notwithstanding, today, but even, sort of 10 years, 5 years, 10 years, coming down a little bit and making, things like home buying a little bit more possible, right? And this, of course, also helps the economy. So I think we've been in a pretty good space. I actually look at the reaction to the report today as being somewhat subdued and possibly a good sign.
And I do want to get your opinion on what's going on the geopolitical front right now. I know that it's a quickly moving picture here, but you think about Israel's attack, of course, on Hamas that they talked about this morning happening in Doha. We're hearing from Qatar right now, Qatar's PM saying that Netanyahu is leading the region to irreparable levels. That, of course, is Qatar's PM. Also saying that the Israeli attack in Doha is a pivotal moment for the region. We know that there's a lot of different hot wars underway at the moment, Dana, not something that seems to be impacting the equity market, not something that even really seems to be impacting the oil market, where you might expect to see more of a reaction. As where you sit as co-CIO at Envestnet, how do you think about these different factors and how they actually play out in markets?
Yeah, so it's probably always surprising to people, right, to a certain extent, what does and doesn't impact stock markets and their investments. It's sort of a known issue, or I won't say issue, but feature of the stock market, that we often don't see a lot of impact on stock returns for what appears to be massive conflagrations in our overall society, or certainly global. And so, yeah, to the extent it's going to show up, it's probably going to show up in oil prices. We're not so much seeing that. We have, looking ahead, potentially a cold winter. This potentially, has some impact on oil prices. But let's face it, we've been in the midst of these wars for a long period of time now. And it's not atypical at all that they don't tend to have direct impacts on stock markets because they're, other than that oil connection. And it's an odd thing, right? Because you're watching something that, from a human perspective, has a massive impact. But stocks don't tend to reflect, just because there isn't that direct linkage.
All right, in conversation right now with Dana Dioria, co-CIO over at Envestnet. And you can see there at the bottom of your screen, we are keeping an eye on comments being made by the Prime Minister in Qatar, responding to the attack.
My pleasure.
Responding to the attack that happened earlier today. Benjamin Netanyahu of Israel, saying that this was a targeted and precise attack on what it says was Hamas leadership that they said were in a building in the capital of Qatar, Doha. The prime minister there now calling this attack a pivotal moment for the region, using the word, quote, treachery, and saying that does have the option of retaliating in some way or another. We will keep an eye on that story. But as Dana was alluding to, Katie Greifeld, this is still a market that is still much more focused on macroeconomic conditions and, more importantly, the bottom lines of corporate America. We're going to get some earnings after the bell tonight, including from one of the biggest players in the AI space, Oracle.
Absolutely. And Oracle having a fantastic 2025 so far, up about 46% on a total return basis. Just one of those big tech companies that has been powering this market to what looks like another record high today. We are through earnings season. It feels like that went through without a hitch. And you just have to wonder, I mean, are these big tech companies really macro agnostic? We talk about, of course, what's happening in the economy. Doesn't seem to really dent what's going on when it comes to the bottom line of those giant tech companies.
Our coverage here of the close here on this Tuesday afternoon begins right now. Romaine Bostick alongside Katie Greifeld. We bring into the conversation Bailey Lipschultz, who helps to lead our markets coverage here at Bloomberg. Joining us here in New York and down in our Miami bureau is Jonathan Levin, Bloomberg opinion columnist. And Jonathan, when you take a look at the market today and all the things that had a chance to bat it around, from Apple's announcement to what happened in Doha, Qatar, and of course those BLS revisions, are you surprised that it looks like we're going to close at a record high?
Yeah, no, I guess I'm not. Can't stop, won't stop with this market. It's kind of wild. But as you're alluding to, you know, the tech story keeps powering us higher. It's kind of rate agnostic. We're going to see where things go with these inflation numbers, though, starting tomorrow with PPI and then CPI on Thursday. That could really change the Fed narrative going into the rest of the month, Romaine.
Hold that thought. You see the numbers on your screen. The Dow Jones Industrial Average a close right around that 45,711 mark. That is a record high, up 0.4%. The S&P 500, 6512 and change, up 0.3%. That's a record high. The NASDAQ Composite up about 0.4%. But we talked about a little bit earlier, Katie. We've seen the laggards today, and that is in the economically sensitive sectors. Dow Transport's down 0.8%. S&P Midcaps down 0.9%, and the Russell 2000 down 0.5 percentage point.
Absolutely. Those little guys just can't catch a break. Let's talk about the sector level, though, and let's take a look at the big circle here. You can see there's actually a lot of green on this screen, which is interesting. You had 8 of 11 sectors finish in the green, even though on the individual stock level, you had more losers than winners. But in any case, what's driving the action today to the upside? Communication services out in front, followed by utilities and healthcare, too. Big day for United Health. On the downside, you do have materials and industrials, also real estate in the red. The tech sector ended up just about flat on the day. We know that Apple didn't have so great a reaction to that big event today, but still enough tech names finishing higher that as a sector, pretty flat, Bailey.
Yeah, Katie, you mentioned United Health, a big day. The stock closing up more than 8%. Biggest gain since August, but closing at the highest level since May, alongside Centene, which had its best day since July 2024. This coming as United Health estimated Medicare star ratings would be better than expected. Analysts coming out saying that those trends were encouraging. So that's a gold star for United Health. Also something that was driving shares of Centene higher. Again, best day since the middle of last year. And I also want to call out a smaller, maybe less known company that had a pretty darn good day today. That's Nebius. The stock was up just about almost 50% this coming after a deal with Microsoft validating its breakup with Russian internet giant Yandex. This coming after it struck a pact with Microsoft to dedicate AI computing capacity worth at least $17.4 billion through 2030.
31. So a big day for those shares, Romain.
I'm going to add an honorable mention. That is Bill Holdings, the cloud software provider. That actually rose in about 1% on the day. Remember, last week there was a Reuters report that activist investor Starboard was taking a stake in the company. We're now learning right now from the Financial Times that Elliott Management is also building a stake. According to the FT, Elliott has built a stake of at least 5% in Bill Holdings. Those shares now up 5% in the after-hours trade. Though, Katie, we are getting some earnings, including, I think, one of Bailey's favorite companies, GameStop.
Yeah, GameStop numbers coming in. It looks like second quarter hardware and accessories net sales beat estimates. Just to get specific here, second quarter adjusted EPS came in at 25 cents. Net sales for the second quarter coming in at $972 million. That is about a 22% year-over-year gain. You take a look at what the shares are doing after hours, up a little bit. Bailey, this looks like good news for one of your favorites here.
Relatively good news. Can't stop, won't stop. GameStop, Katie. I want to call out, though, the collectible sales. They're really leaning into collectible goods and products. So $228-ish million. That's up 63% year over year. There are only two estimates, so beating expectations pretty sharply. This is, as you mentioned, one of my favorites. Maybe not trading on fundamentals, Romain, but trading on fun.
Yeah, the collectibles. They don't sell Labubus, do they?
No. As far as I don't know. I don't know.
Jonathan, you're not a Labubu guy, are you?
My kids have some Labubu. Sure we do.
Oh, man, come on.
Well, there you go. Pop Mart, one of the big stocks out there, has been having a great few months here. I know you're taking a look at some of the decliners that we had in the U.S. markets today.
Yeah, for sure. Well, let's start off with Fox Corp right at the top. We were talking about this earlier in the program. Fox Corp itself closing down 6.7%. News Corp related closing down 4.6%. Of course, as we know, the Murdoch family drama disclosing a settlement Monday to end the family succession story, the real life succession. Lachlan Murdoch ends up as the undisputed leader of the business. But why are we seeing these stocks move today? Lachlan's siblings are ceding their stakes and new shares are being sold at a discount to fund the siblings' trust. So that detail sort of explains what's going on in the market here today. Moving over to mining, copper mining in particular, Freeport-McMoRan had an episode over at an Indonesian mine, leaving a number of workers apparently trapped, but apparently safe as of the most recent update. In the meantime, operations were halted at the Grasberg Minerals district. So we hope everyone's all right there. And the
Hey, Jonathan, I need to interrupt you here. Oracle earnings crossing the wire right now. The company coming in with fiscal first quarter adjusted operating income relatively in line with estimates, $6.24 billion. Revenue in the period looks like a miss, $14.93 billion. The street was looking for roughly about $15 billion. Cloud infrastructure revenue, $3.3 billion, in line with estimates here. That is the red headline crossing the Bloomberg terminal. Of course, that is the key metric everybody has been keeping an eye on as that company's build out, its process, and more importantly, its involvement in the AI data center build-out has been a big part of its story this year. EPS for the most recent quarter, Katie, just a miss by 1 penny, $1.47. The street on average was looking for $1.48.
Yeah, and you can see traders deciding what to do, currently sending the stock higher, though it did initially fall. Let's get to some other earnings out of Synopsys this time. A look behind third quarter revenue, $1.74 billion. That is 14% year over year gain there. Adjusted EPS coming in at $3.39 versus $3.43 year over year. But you can see shares down mightily right now, down about 5%. That might have to do with what we're seeing for what they see with fourth quarter adjusted EPS. The company seeing that between $2.76 to $2.80. The estimate had been for $4.54, so certainly a miss there. You take a look at revenue expectations for the fourth quarter between $2.23 billion to $2.26 billion. The estimate had been for $2.1 billion, so above that range is above that estimate, but still that fourth quarter adjusted EPS number might explain that reaction you're seeing in shares right now.
Let's stay in the tech space. Earnings out of Rubrik, the cloud provider, providing subscription revenue for its most recent quarter, just slightly above estimates at $1.25 billion. The street was looking for $1.22 total revenue in the quarter. Also looks like it came in above estimates. The company's still posting a loss per share. The loss per share coming in at about 3 cents, but that is actually way better than what the street was looking for. The street was looking for a loss of 34 cents. Maybe that explains the bit of a pop that we're seeing in the shares, up about 4%. The company raising its outlook for fiscal 2026. Bailey, I just want to give you a quick word before we go here about the AI trade, and more importantly, how much momentum is left in that. We've seen Oracle, we've seen Rubrik, and now we've seen Synopsys. What do you make of it?
It seems like it's still there. Obviously, you can kind of poke as much as you want at some of the prints, but you look at Oracle right now up 11% post-market. This isn't a small company that's kind of trading on hopium. We are seeing real earnings growth. Obviously, the big question will be inflation data. What does that mean for the Fed? How does the economy shake out? But when you look at the true corporate story, aside from the K-shaped recovery in the economy, it still seemingly is very strong.
All right, Oracle shares are the biggest gainer in the after-hours trade. Our thanks to Bailey Lipschultz and Jonathan Levin, Romaine Bostick and Katie Greifeld sticking around for a deeper dive after the break into the earnings out of Oracle. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick here on a record-setting day for the S&P 500 and the Dow. Fractional gains on the day, to be sure, but that creep higher as investors do show some degree of confidence here that despite the weakening of economic conditions, the rate cuts are on the way that may stabilize the situation. Small cap and mid cap investors, though, not quite so sure about that scenario. And of course, geopolitics has been front and center all day long. The move in Brent crude a bit more modest than what we saw earlier in the session, up right now about 0.6%. Katie?
Meanwhile, we had a lot of after-hours earnings to sort through, so let's take a look at some of the share gains right now. GameStop higher by about 1%, some bright spots when it comes to collectibles, but as Bailey Lipschultz said, this stock trades on fun, not fundamentals. You can see Synopsys shares down right now. Fourth quarter revenue did beat estimates when it comes to the forecast. Can't say the same for adjusted EPS, that outlook there, so sending shares lower. Rubrik a little bit higher, but the big story, of course, is Oracle. Here, the redhead crossing the terminal, that cloud infrastructure. Oracle sees it up about 77% to $18 billion in fiscal year 2026. Shares up nearly 12% after hours.
A nice read on the after hours trade. We should point out that Apple shares also continuing to move lower in the after hours trade after dropping about 1.5% during the CAS session. This after the company introduced its new iPhone lineup, as well as smartwatches and an updated version of its AirPods. Bloomberg's Mark Gurman, the managing editor of Consumer Tech, told us what to expect. And Mark, I guess we got what we were expecting. When you look at the presentation, how it was rolled out, and how they sort of pitch these devices, where do you think the uptake is going to potentially be by the consumer when they're finally able to get their hands on them?
Well, I thought it was a very cohesive keynote. I think they did a really good job from a marketing perspective, trying to get people interested in this new iPhone Air. You know, the iPhone Air has a series of drawbacks that make it pretty impractical for the modern smartphone user. One back camera, mediocre battery life, no speakers on the bottom. It's just that one speaker in the earpiece. So this is not a phone that people should be going out and buying to replace their high-end iPhones, their high-end Samsung phones, you name it. But they pitched it as the future. They pitched it as something super cool to have. And so they're not really positioning this much differently than the MacBook Air originally 20 years ago. And I think it's going to drum up some sales, but really from a practical standpoint, I think the pros are where it's at this year. For me personally, I think the new iPhone 17 Pro Max is really hot. 6 hours of battery life boost. The iPhone 16 Pro and the 15 Pro before it, they have this titanium frame that dissipates heat terribly. It could overheat in your hand. They finally fixed that with this new 17 Pro model. I love the new orange color. The deep blue looks cool. So I think these new Pro phones are going to do extraordinarily well in the holiday season. iPhone 17 comes in at $800, no price hike. So far, so good from what I'm seeing on these new phones.
No price hike. That might explain some of the share reaction, Mark. But I want to talk a little bit about the AirPods Pro 3. You actually saw Duolingo shares at one point drop 5% after we got some details that this model will have live translation capabilities. Duolingo shares did ultimately recover, but talk us through what we learned there.
Yeah, so we reported about 6 months ago that these live translation features are coming. I think they're going to be quite useful. The way it works essentially is if two people who speak different languages are wearing the AirPods and they speak to each other, they'll hear each other but in their native tongue. So that is pretty nifty. Samsung, Google have had these features for a while. Apple introduced these features on their phones and other devices actually in June as part of iOS and iPadOS 26. So this is not entirely new. This is sort of the AirPodsification of it. The bigger thing is actually the heart rate sensor, because now you're pushing more people in the Apple ecosystem towards fitness. They have the $10 a month Fitness Plus subscription. This could get people hooked on the fitness idea and heart rate functionality, maybe push them to eventually upgrade to a pricier Apple Watch. So I think overall a pretty substantial and nifty upgrade, I should say, to the AirPods Pro. And then also, who can forget the Apple Watches? First end-to-end revamp to the line in 3 years. The Apple Watch SE at $250 gets a really great upgrade, better display quality, some new health features. The Ultra, which I've already pre-ordered, satellite connectivity. So if you are lost in the wilderness or you like to go hiking like I do and leave your phone behind in the car, you'll be able to reach emergency services from your watch.
Yeah.
And then you have hypertension detection coming, actually backdated to Apple Watches from 2 years ago. Over a 30-day period can let you know if it senses that you have high blood pressure.
Well, I run straight into the woods and I don't look back, so I don't need the satellite features. But I'm excited for you, Mark. I know it's been a busy day. That is Bloomberg's Mark Gurman, of course, reporting live on Apple's big hardware day. But let's turn back to shares of Oracle, because they are surging in the after-hours trade following results from the tech company. Here to help break it down is Gil Luria. He is head of technology research over at D.A. Davidson. He joins us right now. So first quarter adjusted revenue, it did meet estimates. It seems like a lot of the focus, a lot of the enthusiasm here, Gil, is what they see when it comes to cloud infrastructure revenue at $18 billion in 2026.
And more importantly, they laid out a path where Oracle Cloud, I'm going to have to reread it to make sure, it gets to 144 billion within 4 or 5 years. That would be a massive business that would be in line with some of the hyperscalers. So we're going to have to make sure that we understand what those numbers refer to. But that's what investors are getting excited about, is a roadmap for Oracle Cloud to become almost all of Oracle's business. And that's a huge step forward. It has to include a lot more business from OpenAI, from Stargate, from Microsoft, maybe from Amazon and Google as well, in order to make sense of that. But that's what investors are impressed with right now.
Yeah, and just to kind of put a finer point on that, Gil, we're talking about a company right now generating annual revenue in the $60 billion range. It says that its infrastructure revenue alone will grow 77% to $18 billion this fiscal year, jump to $32 billion, then to $73 billion, then to $114 billion, and then to $144 billion over the subsequent 4 years. That's a phenomenal growth rate, particularly for a company of this maturity and of this size. When you look at where that spending is coming from, Gil, where is that spending coming from?
Really, at the base of it, it's all of us using ChatGPT more. The more we all use AI capabilities, the more advanced capabilities are very compute intensive. So all the providers of those capabilities, which right now is primarily Google, OpenAI, and Anthropic, are booking ahead a lot of capacity. Some of it is through Microsoft, which is then going ahead and booking it through Nebius and CoreWeave. And some of it is directly from those OpenAI through Stargate. So, but really all it boils down to is we are using AI so much more that it's giving all these companies the confidence to book out capacity, compute capacity 4 or 5 years out. And Oracle has done a fantastic job of ramping up its capacity and being able to commit to even that much more capacity within the next 4 or 5 years, that they're getting a lot of these contracts.
And you take a look at some of the comments from the CEO of Oracle coming through, saying that Oracle signed 4 multi-billion-dollar contracts with 3 different customers in the first quarter, adding it was an astonishing quarter and demand for Oracle Cloud infrastructure continues to build. But there's a bigger question here, if you want to be pessimistic, that we could be seeing an overbuilding here when it comes to some of the infrastructure. That is one of the bearish cases that comes up when it comes to some of these names. Is that something that you put much stock in, that concern?
Oh, absolutely. So let's not forget, there's a huge competition, right? Those hyperscalers, Microsoft, Amazon, Google, are competing for data center capacity. We have CoreWeave, Nebius, Lambda, Crusoe competing for data center capacity. And now they're also competing for capital. We're not going to build out this capacity with equity dollars. Most of the dollars that are going to go into this CapEx are going to be debt dollars. And right now, there's going to be an explosion of demand for debt capital to fund these data centers. So a lot of competition for data center buildings, for the electricity that goes into them, for the capital that's required to build them out. So these projections are very rosy, and they're saying that they're already in their backlog, but it's unclear that all these data center builders can build all this capacity all at once and have availability for those scarce resources.
All right, Gil, I got to leave it there. Really appreciate you taking time for us. Gil Luria, head of technology research over at D.A. Davidson. We should point out Oracle shares up 20% right now. If this holds into the cash session tomorrow, this would be the biggest post-earnings pop for that stock going back to at least early 2020. We're going to stay on Oracle and stay on AI and talk about what it all means for the broader ecosystem. New York University Professor Meredith Broussard going to be joining us in just a bit to talk about some of the challenges for that AI spend going forward, particularly when it comes to copyrights. This is The Close on Bloomberg. Apple, the latest tech giant to face a copyright complaint over using pirated books to train its AI model. It's raising questions about whether it constitutes as fair use or infringement. This comes after Anthropic settled with authors for $1.5 billion over similar claims. Meredith Broussard is professor at NYU and author of, quote, Artificial Unintelligence, How Computers Misunderstand the World. And you've been doing a lot of research into just the whole idea of, I guess, what we own and, more importantly, what a lot of these AI companies think they have the right to use. Talk about the Anthropic settlement. $1.5 billion to settle complaints from authors that their AI models were basically using their content without permission.
Well, so this is a really interesting case. It's not just about copyright, but it's also about piracy. So machine learning models are trained on these huge data sets, as most people know by now. And Anthropic knowingly used a pirated data set. So a data set that had been stolen, and it contained hundreds of thousands of books, millions of books. It depends on which data set we're talking about. It depends on how many items are in it. But at any rate, using knowingly pirated data sets is something that all of the big AI companies
this is
have been
widespread?
doing. This is very widespread because there aren't that many big data sets that you can use for training these huge models. Right? There's something called the common crawl, which is what everybody uses. It's just a crawl of all of the available web pages on the internet. And not many people are making that kind of data set. It's just the common crawl people.
So these sorts of cases, and this brings us, of course, to this copyright class action that Apple was just hit with. It sounds like this is maybe the way of the world, that it feels inevitable that we're going to see more and more of these types of cases.
We absolutely are, because all of these companies, if they are using pirated data, they have broken the law. Like, it is criminal behavior. And one of the things I've heard argued is that Anthropic settled for $1.5 billion because it was going to be extraordinarily expensive to pay out a copyright claim. So they're paying $3,000 to each of about 500,000 authors, right? Well, if we look at the pirated data sets, okay, they have different names like Books 3 or LibGen. There's one called something like Red Banana. And if you look at each of those pirated data sets and you look at how many books and how many authors are in each one of them, you've got millions. If you're paying hundreds of thousands of dollars to millions of authors, well, but, you know, 1.5 billion looks really small.
But not to take sides here, but that's kind of what you're supposed to do. They didn't create the material. I know there's this debate, and we know this as working in the media as journalists, this idea of fair use. And you can use certain clips of things as long as it's sort of in service of maybe telling the story without necessarily trying to profit from those things. Is that not what they were doing?
Well, so this is still working its way through the courts. There was a ruling recently that said that using copyrighted materials to train AI can be fair use, right? But in this particular case, this was about having used stolen data and profited off of it.
All right, Meredith, unfortunately, we have to leave it there. Hope to have you back soon. That is Meredith Broussard. She is a professor at NYU. We do have some breaking news here out of the Supreme Court. This is hitting the headlines now. The Supreme Court will review Trump's tariffs on a fast-track schedule. Of course, this follows that ruling last week, but now just learning that the Supreme Court will review those tariffs on a fast-track schedule. So we'll see if we get answers there soon. We'll continue to follow that story.
And we should just point out that those arguments are set to take place in early November, so potentially a decision that we could learn before the end of the year.
This is Bloomberg.
All right, markets were rattled just a bit this morning after an unprecedented, unprovoked, and unilateral attack by Israel against Hamas leaders in Doha. Drawing warnings from the White House, Press Secretary Caroline Leavitt saying the attack didn't even advance U.S. or Israeli goals in striking Hamas. The President of the United States just moments ago taking to Truth Social, saying that it was not a decision made by him and that the warnings coming from some of Trump's surrogates came a little bit too late to stop the attack. The Qatar Prime Minister also speaking just moments ago, saying this won't stop the mediation role that Qatar has played in that region. Joining us right now is Wayne Sanders, Senior Defense Research Analyst over at Bloomberg Intelligence. And for Wayne, just give us a little context here, too, because I think one of the reasons why this shocked a lot of folks is that Qatar, to a certain extent, has been kind of seen as kind of like the Switzerland of the Middle East. It really wasn't taking sides, or at least that was perception, but it was trying to facilitate, kind of to be that go-between between Israel, between Hamas, and some of the other terrorist groups, the idea that they could potentially broker a peace deal. What happened this morning?
Yeah, thanks for having me on. I agree with you. I think that it's interesting. Qatar has played a strategic partnership role with the United States since 1972. They've been a key mediator in the Middle East. That's normally one of the areas they've mediated for Afghanistan as well in the past. They're a major non-NATO ally. And you look at Al-Udeid being one of the U.S. air bases. That's one of the 4 deployed locations for U.S. CENTCOM, for U.S. Central Command. So from that's normally one of those areas where people normally look at Qatar and say, this is an area that's okay. This is an area that we normally wouldn't try to attack. So we were a little bit surprised because this is Israel attacking a sovereign capital against a non-battlefield area. You've seen Israel attack into Iran, Syria, Lebanon. All of those things have happened in the past, but not against somebody like Qatar.
And of course, President Donald Trump seemingly distancing himself, just saying in the last hour or so, or just a couple minutes ago, that this was a decision made by Prime Minister Netanyahu. It was not a decision made by me. But talk to us about the U.S. role in this when it comes to its relationship with some of the Gulf states, how this affects that.
Well, I definitely think this is going to be one of them, right? You look at the way that this partnership is set up, you have both on the Israel side and you have Qatar. Even if you're looking at U.S. companies, you've got Boeing on the Qatar side, Boeing with F-15s and Apaches, $12 billion that go to Qatar, RTX and their Patriot and ASAM systems as well, Lockheed with their PAC-3 interceptors. Then you have Israel on the other side, strategic, strongest ally, bipartisan congressional support with $3.8 billion annually. That's on that, as well as Qatar having the liquid natural gas as well. You put all those pieces together and you have a very unique dichotomy in terms of something that we haven't had to see before.
All right, Wayne, really appreciate your insight there. That is Wayne Sanders. He is Senior Defense Research Analyst over at Bloomberg Intelligence. Let's bring this conversation to commodities because oil prices firming as markets digest the implications of the flare-up. Traders seemingly brushing off OPEC Plus starting to revive its previously halted supply lines over the weekend. Let's discuss it all with Frank Monkam. He is head of macro strategy and trading over at Buffalo Bayou Holdings. Great to see you in person.
Hey guys, pleasure to be here. Thanks for having me on the show.
So let's talk specifically about oil. This is a conversation we were having at the top of the show with Rebecca Babin, that this market, oil specifically, doesn't ever seem to sustainably build in a risk premium when we get geopolitical flare-ups such as this. And I wonder what you make of that, especially in the context of what we learned today.
Yeah, I mean, listen, I think, when you see these flare-ups, I think it's important to kind of contextualize all that within what's going on within the broader macro backdrop. I mean, these flare-ups are going to happen, but at the end of the day, and it comes down to whether we're going to see some supply disruptions or not, right? Mm-hmm. And the market at the moment is very oversold and very, positioned net short to an extent that we haven't seen in many years. So even though the consensus is for prices to move lower later this year, when we start seeing some surplus in balances, it's hard to see people putting shorts on at this time because there's still a bit of upside risk here and there with the Russia-Ukraine situation still haven't been sorted out. We saw another flare up today with the Hamas situation, but it's more a positioning story more than anything else. That's why the market is very reluctant to sell off at the moment. But the bearish view remains intact.
Is that true across asset classes, that it comes back to positioning, it comes back to the macroeconomic environment? Because you take a look at bonds being sold today, equities rallying to all-time highs, also seemingly brushing off.
Yeah, I think that this is kind of the exit window to Labor Day, as I like to say it. Every time the market comes out of Labor Day, it always looks for a new theme to kind of trade on. And this time around, it's actually the Fed, the weakness in the labor market. But there's a little bit of a caveat this year versus last year, because it looks a bit like last year, weaker payroll, Fed needs to cut, some people pushing for 50 basis points. But this time is a little different, in my opinion, because of this whole issue around the Fed independence story.
Well, when we talk about the Fed, I mean, we started this day with a big look at those revisions on the labor market, a labor market that, at least on the surface now, we know was a little bit weaker than what we thought in the past year. Then there's the inflation side of the picture. You get PPI tomorrow, I believe, and then CPI after that. Those really haven't budged a whole lot, at least not to the downside in the way that the Fed would have liked it to see. What do you expect to see out of those reports? And do you think that's anything in there that could potentially change what the Fed does next week?
I think we're probably setting up for sort of a stagflation light setup here, macro-wise, meaning inflation a little bit higher than what we'd liked, growth kind of, tapering off a little bit. But the Fed is clearly leaning towards the labor side of the mandate versus inflation. So I don't think we're really going to see any kind of reaction function from the print start. We'll see from PPI and CPI from the Fed. I think 25 basis points on next week is a lock. It's going to take a lot for the Fed to really move to say we're not going to cut or we're cutting 50. So I think it's going to be a bit of a non-event, maybe a volatility sort of inducer a little bit here. I'm in the camp that I think bond volatility is really kind of underestimating the risks that are ahead of us, particularly the risks associated with Fed independence. I think that's a sovereign risk element that the market isn't pricing properly.
You think the bond market is underestimating, underpricing that? Well, then what is the equity market doing? Because we just hit a record high on the S&P.
Well, here's my take on equities. I'm just going to give you the skinny of it. Right? I think equities are playing to a completely different drum. I think we've seen a tectonic shift in a way that retail really goes about managing wealth management, managing their wealth, right? Essentially, the catalyst that we're seeing in the market right now is retail basically having a totally different attitude to the stock market. Dip alpha is a real play that's not going away. There's a lot of liquidity in the system. And frankly speaking, the way that people think about the stock market nowadays, if you look at like Gen Zs, for instance, when you're 25, 27-year-olds, 20 years ago, your first thing you wanted to do when you saved money was to buy a house. Right. Today, what you want to do is to be on Robinhood buying stocks on dips, right? And selling options. So it's a very different market. And unless we see a recession or the labor market really starts rolling over, I think equity is going to get supported. We're going through a bit of a seasonal patch here where things could get a little weak here. With buybacks, tapering off a little bit. But as we come out of that later in October, I think things are going to get supported and the equities market is going to be fine.
It's a fascinating point when you think about retail's influence, sort of explaining the differing attitudes of the equity and the bond markets, because you don't have that same retail investor base in bonds. You don't have the equivalent of Robinhood for the Treasury market.
There's no dip alpha in bonds, right? That just doesn't exist, to your point. So I think that it's very important for investors to realize that we're going to see a very different reaction function in the 60-40 portfolio over the next, I think, 5 to 10 years here, as Gen Zs really continue to increasingly participate in the markets. And that's why, and I've said this, I've been on the record saying this, gold, we've been along that asset class since the beginning of the year, even though it was, up 30% last year, still up year to date 40%. I think it's a great diversifier to the 60-40 portfolio because it's kind of checking all the boxes in terms of everything that's going on in the macro landscape. So I think that investors got to keep an eye on that, given everything that's going on with different dynamics of our retail flows and sovereign risk when it comes to the bond market.
And we should point out spot gold trading at another record high, at least intraday on the day, above that 3,600 mark here, and a lot of expectations that we could get close to 5,000 over the next year or two. Frank Monkam is head of macro strategy and trading at Buffalo Bayou Holdings. Katie?
Meanwhile, we do have some notable movers in the after-hours trade. A lot of earnings names coming out. You can see Synopsys moving much lower now, down about 13%. Rubrik also a little bit lower here, off 2.5% in the after-hours trade. GameStop having a pretty solid reaction, up about 4%. But the star of the show is what is going on with Oracle, now up 22.6%. This is a company that has a market cap of $678 billion. We could be on $1 trillion watch soon.
Yeah, this is this move is potentially phenomenal here if this carries over into the cash session, but there's a big reason for it. We were talking about Luria. We're talking about a company that generated $60 billion in revenue that is now saying that it's cloud, that basically it's AI business. That cloud AI infrastructure business alone might actually eclipse that over the next couple of years, saying that could be $18 billion this year, and at some point over the next 3 to 4 years, surpassing $100 billion in revenue just from that unit alone. This is a transformation of a company.
Yeah, dizzying numbers here. Company management calling this an astonishing quarter, and clearly traders agree. Again, Oracle shares up over 22% after hours. This is the close on Bloomberg. All right, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, Sébastien Lecornu, France's defense minister, tapped by Macron as the new prime minister, the country's 5th prime minister in about 2 years. So we'll have to see how long he lasts.
All right, and I'm keeping an eye on Eric Trump, of course, the son of the president, has been removed from a planned board seat at the fintech firm Alt5 Sigma. This is according to reports. The move coming following the company's consultation with the NASDAQ, which raised some concerns.
And third on the docket, we have Klarna's CEO, remember the financial technology firm, expecting to price its IPO of as much as $1.27 billion above its marketing range. That is according to people familiar with the matter. The IPO window is wide open. Wide open here as we keep an eye on that, and we pivot from fintechs to fashion, and specifically footwear. The startup Syntilay is using AI and 3D printing to design their shoes. A splashy event in the heart of New York City where customers can get their hands on a custom pair of those shoes. Ben Weiss is the founder and CEO of Syntilay, and he's been working alongside a legend in the footwear industry, Joe Foster, footwear advisor to Syntilay and the co-founder of Reebok. Great to have you both back here on the program. And Ben, I do want to start with you, the big event in Times Square, and more importantly, what exactly are you showing off? What am I going to be able to do in the future that I can't do today?
Yeah, thank you for having us. So in Times Square now, we've created a first of its kind experience. You are now able to walk onto a machine. It scans your feet, makes a 3D model of your feet. We're able to get information more than what we could do with our online scanning system, like the way your toes are shaped, the way your heel's designed, pretty much the same information you would take into account when making custom orthotics. And now we can give you a fully custom-made 3D printing shoe with this information 4 to 6 weeks later in the heart of New York City, in a spot where so many amazing tourists are coming through, in a store called Tomorrow that just opened up in the Candler building. It's a game changer for footwear sizing. There are so many people that are struggling to get proper fitted shoes, and now we have a solution for that. And it's a solution in an area where a lot of people can get access to it.
Joe, give me a sense here, though, of the balance between people sort of making a decision about buying a pair of shoes based on, comfort and sizing versus, styling and maybe some of the, for lack of a better phrase, some of the more superficial things that, let's just face it, a lot of us tend to focus on.
Well, we're now seeing a change. We're now seeing this disruption. We have politics which is coming in this and saying, tariffs. And so it's wonderful to be able to look at something which is going to disrupt that. And with 3D printing, you can actually make this product anywhere in the world, which means that you can do it in America. So, this is something that is changing the way that people look at product. And, sneakers have really influenced the street for 50 years. And it's moving on. They're moving towards slides and clogs. And this is where 3D printing is coming in and making a difference.
Well, Joe makes an interesting point here, Ben, that when it comes to 3D printing, you can make these shoes anywhere, and you can specifically make them in America. When it comes to situating this in the context of tariffs and the geopolitical landscape, I have to imagine that maybe it isn't something that you had in mind when you set out to 3D print sneakers, but it has to be a huge benefit.
Yeah, it's something we're actively thinking about, and we are putting a plan in place to try to make this happen. We believe that 3D printed approach for footwear is a whole different way to make an entirely 100% American-made footwear product. And, you don't have the same type of labor requirements for 3D printing. It's just a much easier process. So, we're looking at a lot of companies now and they're trying to figure out their production, and just to shift over that typical production from China or these other places to the US is quite an effort, and you have to find the labor force. We get rid of one of the biggest aspects of this, which is the labor force. I mean, this is automation. You're able to just print out a shoe without anybody really involved in that, and just need to have the proper processes in place. So this production method can really be a game changer in that, and we're actively looking into how to produce in America.
And Joe, talk to us, though, about the integrity of the shoes. Romain got into a little bit of this when it comes to people buy shoes for style, they buy shoes for comfort. There's people who, of course, buy shoes for performance. And when it comes to 3D printed shoes, are you able to get the elements that you need to have these shoes actually be able to withstand some of the athletic demands that you might put on them?
Well, we're not really looking at that side of performance. What we're looking at is how do you change the methods that are used now. Traditional methods, you will never move out of Asia because of the volumes you require. So that's difficult. And let's go back to Reebok. Reebok, when we were starting and we moved forward, we looked for white space. And white space is, where is it we can go now and try and make a difference? Well, 3D printing, AI designing, and scanning your foot. These are three different areas that we got to work on. We've got to develop these. Okay, 3D printing is not particularly fast at this moment, and the big companies can't really look at it because they need more volume than we do at Syntilay. But we can get the volume we need to make that difference. And in doing so, we're also looking to 3D printers. Come on, guys. Let's look at developing 3D printing. Let's make the time to print a shoe, which is probably almost 12 hours to print one shoe. Let's get it down to 1 hour. This is developing different methods. It's not performance as we see performance today, but as we move in this area, we're going to look at all the different areas where we can become performance, as against just changing the landscape of shoes that people wear.
When it comes to athletic shoes, though, Joe, I am curious as to what people want right now. Companies like Nike have sort of been at a bit of a crisis as of late. The idea of, do you go after the folks who just want it for fashion, or do you sort of double down on the athletes? The idea of people who want those athletic shoes for actual athletic purposes.
I don't think we can change that landscape at the moment. I think athletic shoes will still come from traditional manufacturing, where you've got different materials, where you experiment with different rubbers, and you want performance. And Reebok want performance, Adidas want performance, and Nike want performance. What we would like to see with Syntilay is that, because the landscape is changing now from sneakers, which are street, we're now looking at clogs, we're looking at sliders. So people are looking for footwear which is comfortable and easy to wear. And what we have, we're offering something which is a personalized measurement. These shoes are custom made for you. So it's looking at the different areas that we can change the street shoes and what people want. And as we move into this, we can challenge our people with 3D printed. We can challenge them, look, we want to have a few variations here. We want to look at performance. We want to look at comfort. And so it is a process. But meanwhile, with Syntilay, it is putting out to the people something, this is different. Come with us and take the journey.
Well, Ben, let's talk about price points here. When it comes to, these custom 3D printed shoes, what is the price differential versus custom shoes that were maybe made the old-fashioned way?
It's a great question. So we worked really hard from our first version of our Explorer slide we launched earlier in the year. That was the first AI design slide in the world. We worked to get that price down to produce a lot. So we're now actually able to offer for our sneaker here, the Luminez, the most AI-generated physical product of any category, a price point of $189 for a fully custom-made shoe, one of one. So it's pretty competitive to what you could pay for a traditional sneaker, and the fit experience is really unparalleled. I went through the process many times. I've got my feet scanned in person in our spot in Times Square, and the experience of getting it done with this high-quality scanner, it's really incredible. You feel like the shoe is made for you precisely. It feels like it's like a glove-like experience with footwear, and you don't want to try anything else after that. And so we think that now making this accessible, having an accessible price point, our slide's $119. The version 1 of it was $150, is going to be a game changer.
All right, I have to leave it there, guys. Really appreciate you taking time. Ben Weiss, the founder and CEO over at Syntilay, and now being advised by a legend in that industry, Joe Foster, the co-founder of Reebok. We'll be back in a moment. A busy day for investors on this Tuesday. It could potentially be busier on Wednesday. We'll set you up for what to watch over the next 24 hours. This is Bloomberg. All right, it was a busy day in markets on this Tuesday. As we move into the overnight hours and into tomorrow, it promises to be even busier. We start in China, where we get a read on the second largest economy and its inflation numbers.
And then if you want to wake up early, 3 a.m. Eastern, you can tune in to European Commission President Ursula von der Leyen delivering the annual State of the Union address to the European Parliament. I'm sure you'll be up.
I might not be, but if I am up, I probably also won't be watching. But we should point out we will have full coverage of that here on Bloomberg. And actually, we make light of it, of course, but we talk about kind of I won't necessarily call it turmoil, but you talk about some of the changes in France, in Denmark, obviously a lot of the budget issues in Germany. She's got a lot to address, and I'm not sure she has the power necessarily to resolve all of it.
But probably she has some things to say. We also get Chewy earnings tomorrow as well. Those coming pre-market. An interesting check there, of course, on the pet economy.
And of course, so we turn back to the United States here, where we are going to get a better read here on U.S. inflation. Wholesale producer price numbers scheduled to come out tomorrow, 8:30 a.m. Washington time.
Let's take a look at Oracle shares just before we go and hand off to Balance of Power, because Oracle shares up 22.6%, boosting some of its peers there, NVIDIA and CoreWeave also higher, setting up to be quite an open tomorrow if these moves hold.
Yeah, and I found Oracle probably one of the more fascinating stories of this year. Obviously, Larry Ellison and sort of the close connection he has with the Trump administration, really providing an old tech economy stock and turning it into a new one. That does it for us here on The Close. Balance of Power is up next, right here on Bloomberg.